evening, everyone. Today is 18th March 2020, and this is episode 3 of my podcast. So, let's start. So, we'll do a market review. We'll be discussing the tech sector today, and I'll be answering a user question. So, 3 parts in today: market review, what the market has been doing, what did it do today. I'll also be talking about the tech sector in general and 4 stocks in particular. So we'll be covering Google, Facebook, IBM and Tesla. And I'll be taking a user question of why it is important to keep cash when the market is going up. So someone asked this question to me online. So I'll try and answer that. So let's start. So again, a bad day for the market. S&P 500 was 5% down. Dow Jones was 6.3% down, 4.7 Nasdaq was down, and TSX was around 7.6% down. And I don't think this is the bottom yet. So we are closing down the economy in North America, and the expected peak of this virus is around 45 days from today. So things would get worse before they start getting better. And it's a major impact because economies have closed down. People are not going out, and a lot of people are asking, like, government is declaring stimulus, US is declaring stimulus of around 800 plus billion dollars, Canada around 82 billion dollars. Would this help the market? My answer is markets are driven by consumption. They're driven by consumer spending. So even if people get some money from the government, but if they don't spend it, it doesn't reflect in the market. It doesn't help market much. So I'm not a big believer in government surpluses and government stimuluses. So I focus on consumer spending data, and I think that consumer spending is going to take a big hit right now. So let's start. So we are going to discuss about tech sector, and personally I am right now overweight on this sector. Before I start, this podcast is just for education purpose. It has nothing to do with advice. If you actually want to invest in any of these stocks, then you need to connect with an investment advisor, or you're taking the complete risk on you. I'm just going to share what I think about this sector, about these stocks, and what I am doing. I'm not going to tell you what to do or how to do it and all that stuff. It's on you. This is not an advice show. This is an education show. So we are going to talk about tech sector. I'm currently overweight in my portfolio in this sector. The reason is this sector, especially software as a service, doesn't have big supply chains. So they do not have manufacturing hubs in China. They do not have manufacturing hubs in Vietnam that have got disturbed because of this virus. So software as a service works well because it doesn't have global supply chains. It has supply chains, but people can work from home. It's not reliant on the transportation sector. So that's the one thing I like about it. Second, generally tech sector has low amount of debt. I'm not talking about startups. Big tech has very low amount of debt as compared to the other sectors. So if anything survives after this carnage, I think it's going to be tech sector. And also people are working from home. Supply chains are moving into North America after this debacle that we faced. So I think tech overall has a bright future from here on. There would be a lot of automation. Companies don't want to rely on humans because virus can screw things up. There would be a lot of work from home. That culture would be increasing. So again, the big tech benefits in that. So overall, I'm overweighting my portfolio right now on tech, and I'm always a big believer in tech. So that's also one of the reasons. So we'll be talking about 4 stocks: Google, IBM, Facebook and Tesla. So everyone knows what Google is. It's one of the largest, means it has 90% plus market share in global searches, and it's one of the companies that has best balance sheets in the industry. Google has the best balance sheet of almost all the companies across the world. They hold lot of cash, they have low amount of debt, and their business model is very less capital intensive. So they don't require a lot of capital to grow. So one of the best balance sheets in the world. If you want to look at Google, it's one of the best balance sheets. So few features of Google. It is currently managed by the chief executive officer is Sundar Pichai, and it's based out of United States. It has global presence. It is into search engine. It has a artificial intelligence vertical. It is into self-driving car. It is into medical biotech, and so it's quite spread out. So what's happening with Google? From its high, it is 28% down. The current price is 1091. Few features about Google that I really like: $44 of free cash flow per share. So it generates a lot of good free cash. And I don't think coronavirus is going to damage that cash flow much. It is going to have some impact, but it's not going to be as big as what Disney is facing or what airlines are facing. So it could be pretty stable. I don't think it's going to increase, but it should be the same. EPS around $47, generates profit, has generated profit for a long time. This I love about Google. Debt to equity 8%, debt to asset 5%, virtually no debt. It is virtually a debt free company. And look at this, interest coverage ratio of 342. What does interest coverage means? It has 342 times earnings as compared to its interest payments. So even if earnings fall by 50 times, it's not going to be impacted much. It's not closing down after this virus. P ratio right now it is 23, all time low it is around 17. So the P ratio is very low. Price is actually right. I own a lot of Google stock personally, so I'm not looking at this price right now to buy. But if you have never owned Google, this could be the point where you start looking into this stock. Return on equity of 18%, has maintained it for a lot of years now. Institutional ownership 87%, that expected with big tech. Long term support that personally I am looking at is around 980, because then it starts trading around 20 PE. And if you can get a company like Google with 20 or below PE, it's a steal. You're stealing money from the markets. So 980 is what price I am looking at personally, because then it starts trading at 20 PE, which makes it extremely lucrative. So one more support level was 1060. That's a technical support. So if you have never looked at Google, never owned Google, something to keep in mind. Support is where you start buying it at. So it's very near to its support. Next stock that we are going to discuss is IBM. IBM has its Watson, and it is a big player in supply chain management too. So it is having some projects in supply chain software side, and it has Watson engine where it creates various artificial intelligence applications. Has been around for many years. Very stable company. Lot of pension funds own it because it has great dividend. Dividend yield right now is around over 6%. And this stock over the last, I bought it around 2008 and pays very good dividends, and this stock has filled my portfolio with cash. So you buy dividend generating stocks because they fill your portfolio with cash, so your cash component goes up. Right now I'm sitting at around 40% of my portfolio is into cash. That is because I took some profits when markets were too high, too hot, and I also had a lot of dividend stocks in my portfolio. So even if it doesn't grow, it keeps on paying you dividend, so that generates cash that you can use when the markets go down. So amazing way of investing. If the dividends are growing, good thing. Down from highs, 34% down since its peak. Current price of around 103. Free cash flow around $14. That's very good. EPS is 13.61. So that's decent too. The thing that bothers me about IBM, and it has always bothered me, being in tech company, it has a lot of debt. So debt to asset is around 44%, debt to equity is too high too, and interest coverage ratio is only 7 times. So it only has 7 times earnings to cover its interest payment. So it's a leveraged debt company. So that's the only thing that worries me about it. Otherwise, it's a good catch. P ratio right now, it's below its all-time low. So it has never traded this low in contrast to its P ratio. P ratio is the how cheap or how expensive it is. Right now, looking at its P is extremely cheap. It has never been this cheap. Return on equity, amazing for this stock, 50%. It has a very high dividend payout ratio too. Institutional ownership has gone low because Warren Buffett sold a lot of stocks of IBM because it was not giving him what he expected. The growth was not there. So institutional ownership has gone down over the years. A lot of pension funds own it. So people who are looking for pensions, looking for dividends, it's a good stock to hold. Long-term support that I am looking at is around 80. I feel this stock has some risk involved because the debt is too high, the debt to asset is too high, and doesn't have much earnings to cover its interest. So I'm very conservative with this stock. I own a good chunk of IBM, but the price that I would start looking at is around 80. If it doesn't fall below 80, so bad, right? Dividend yield is amazing, 6% dividend. Once again, I cannot emphasize the role of dividend in your portfolio. Dividend paying stocks increase cash that can be used when the market dips. So amazing strategy. So always look at dividend paying stocks. Next is Facebook. Facebook owns Instagram as well as Facebook, and it has few other side businesses too, but major businesses are its two platforms, Facebook and Instagram. Then it's an second best balance sheet in the industry is Facebook. Very good balance sheet, manages its debt well, lower amount of debt, doesn't require much capital to grow, so that's also important. So let's see features about Facebook. So it's around 34% down from its top. There were a lot of things going wrong with Facebook, like it was in news for all bad reasons, like Cambridge Analytica and the US Congress hearings. So that also plays an impact on the psyche of investors who invest in Facebook. So it's down around 34%. Current price is 146. Excellent free cash flow, 7.43. EPS of around 9. Debt to equity, again not as low as Google, but very reasonable of around 8%. Debt to asset around 10%. So if anything survives out of this carnage, it's going to be Google and Facebook. Low amount of debt, good. It has a very high interest coverage ratio too. So it has earnings to cover its interest. So anything survives out of it is Google and Facebook. So keep a close eye on it. P ratio is around 17. It is almost at the lowest. It was not a long while before it got listed. So we don't have data from 2008 and before that. So P ratio is around 17. It's the lowest it has ever been. So if you do not own Facebook, time to start looking at Facebook. ROE is around 20%. Institutional ownership, big tech 83%, reasonable. Long-term support, I own Facebook already and a good part of it. So my price that I am looking at to get into Facebook is around 130, which gives it a PE of around 15. And at that PE, you're stealing money from the market. Believe me, 10 years, if you get Facebook and Google below 20 and Facebook around 15, you're stealing money from the market. You have huge potential for capital appreciation there. Doesn't pay dividend, reinvest all its profits to grow. So little bit different, growth oriented investors can look at Facebook. Next is Tesla, and I'm a big fan of the cars, not so much about stock, and I did not invest in Tesla for a long time because it was not making any profits. And I broke this rule in 2018 when I got into Tesla. I bought it around a reasonable price, so I don't remember exactly, but my cost of acquisition was around $200, and then when it went to around 800 plus, I removed my capital. So my cost of acquisition right now is around zero in Tesla, because whatever I invested, I withdraw it. But I'm going to stay invested in this company. But I broke all my personal rules to get into this, and I do not invest with hypes. I do not invest with things that market is hyping, but I got, because I really like the tech behind it, I understand the machine learning part, and it's way ahead of all the competition right now in the powertrain, as well as the battery tech, as well as even the artificial intelligence side. And I personally believe that if anyone can break the self-driving automation paradox, it's going to be Tesla. So few things about Tesla. It's a high risk trade. So personally, I do not put much of my capital in Tesla. I have some stocks, but the cost of acquisition is almost zero because I removed my capital, and I'm going to ride it. So no harm in riding it when your cost of acquisition is zero. So down from high around 60%, but you also have to remember it was flat for years. Then it took a big jump since the month of December to the month of Feb, and then it started falling. So there was it went up multiple times in that span. Then it again started to fall. So down from its high around 60%. Current price is 361. It generated free cash flow this year, so that was a big change. It was not a profitable. It's not a profitable company. It was not generating any free cash, but this year was the first year where they generated some free cash. Debt is very high. That bothers me. 220% debt to equity, debt to asset ratio of 42%. So debt in Tesla is extremely high. So if the sales stop, if the earnings stop and banks come calling, Tesla is going to suffer a lot. One good thing is they generated they sold some equity, so they had an equity issue in between, and they generated some cash out of it. So that cash may help it if the banks come calling. P ratio is not applicable. It is almost at the lowest end. The ROE is negative 14%. EPS doesn't. Institutional ownership is 63, so it's not like big tech 80%. So there is some scope where big money can come in. So why do I look at institutional ownership? If you're looking at institutional ownership and it's a mid cap company where institutional ownership is around 60%, then there is a potential that when it becomes a large cap, institutional money can come in and bump it up from 60 to 80. So there could be a big price movement in future. So that's why I look at institutional ownership. Long-term support, personally I think it's a high risk trade. If I ever have to get back into this stock, which I'm going to let this coronavirus ride and let the markets calm down and only then think of getting into it, I would look at a price of 200 and below. High risk trade. And that completes our thing. So we looked at Google, best balance sheet in the market. We looked at Facebook, probably the second best balance sheet. Both of them have low debt. If you have never owned tech stocks, good price point even today, but it can go a bit lower. I'm hoping for it to go a bit low to catch the fish. Then we also looked at IBM, a good dividend paying stock. Dividends are important because they generate cash, and that cash you can use when the market actually goes down. And also we looked at Tesla, high risk trade, leading in its field, means the powertrain, the batteries, the self-driving tech, safety wise, it's one of the safest cars that's there on the market. So all features are good, and I don't believe it's a car company. Personally, I think it's a software company that makes car, and they're going to make a lot of money from the data that they are collecting. So that's the potential that I am looking at. But again, high risk, below means over 200, I see a lot of risk there. And I am personally a very low risk investor. I do not like to take risk. I do not go with hypes. So keeping my money in the bank right now. not investing in Tesla. There was a user question, why keeping cash is important when market is going up. So personally, I'm holding right now 40 or 45% cash in my portfolio. The reason is when the market starts going up, I start selling. And what do I mean when market goes up? I don't look at the price. I don't look at Nasdaq. I don't look at S&P 500. I don't look at stock prices. I look at PE ratios. When PE ratios are too expensive as compared to the past, I start booking in some profits. So if earnings are growing and price is growing along with the earnings, the PE doesn't change much. So I stay invested. But when price takes over earnings, I start booking some profits. And whenever that happens, I keep it in cash and I look for opportunities and buy it when the markets are low, like right now. And this is extremely important to do. When the markets are going up, when there are good times, start taking in profits. And especially high risk trades like Tesla, remove your capital as soon as you can. So if the stock doubles up, remove your capital. Whatever is remaining in that stock, it's just your gain. So then let it ride. There is no risk there. But high risk trades like Tesla, or there may be few more that we would be discussing, never keep your capital in those high risk trades. Always remove your capital and ride the gain play. And also, so I answered this, keeping cash is important. When the markets are really heated up, it's a good idea to have around 30 to 40% cash. And it looks stupid then. A lot of people were laughing at me because I was holding so much cash. But now I am laughing. So always follow rules, always follow discipline. It's not about hype. It's always about buying good companies at the right time. Thank you for listening to today's podcast. In the next podcast, we'll be looking at few other stocks. If you want any stocks to be covered, please get in touch with me through email or through my social networks, and see you in the next podcast.